You know how it goes. One day, the markets are chugging along just fine. And the next, it's a sea of red. It happens so fast, but there's almost always a reason. So today, we're going to unpack a massive global market sell-off to find out exactly what caused it. Let's dive right in. So it all kicked off in Asia. As traders were getting to their desks, their screens just exploded in red. From Tokyo to Hong Kong, markets were tanking hard. And you can bet every single investor was asking the exact same question. Why? So what was the trigger? Is it another inflation report? Some terrible earnings data? Nope. The answer actually lies thousands of miles away. And it all started with a single incredibly powerful threat that sent a shockwave through the entire global economy. Let's trace it back to the source. Okay, so our story begins with a geopolitical flashpoint, and it's centered on one of the most critical waterways in the entire world, especially when it comes to the global energy trade. And this right here, this is the statement that lit the fuse. A threat from Iran's new supreme leader to shut down the Strait of Hormuz. I mean, we're talking about a vital artery for the world's oil supply. This isn't just some political chest thumping, it's a direct threat to choke off the flow of global commerce. And just in case anyone out there thought maybe it was a bluff, well, Iran's Revolutionary Guard Navy commander quickly doubled down. He warned of the harshest blows. That little bit of reinforcement, it turned a really serious threat into what felt like an imminent crisis. And as you'd expect, the markets reacted instantly. So, you've got this huge threat hanging in the air. What's the immediate effect? Where does it hit first? The price of oil. This is our first ripple. And boom, there it is. Brent crude. That's the big international benchmark for oil prices. It didn't just creep up. It smashed right through the $100 per barrel mark for the first time in years. You have to understand, $100 isn't just a number. It is a massive psychological barrier. It signals serious stress in the energy market. It's the kind of price that makes everyone, from Wall Street traders to you and me at the gas pump, sit up and pay very close attention. And just look at the speed, a jump of over 9% in a single day. That's absolutely massive. It just goes to show you how seriously traders took this threat. A move this sharp, this fast, well, that's what we call a price shock. But here's the thing. An energy shock never, ever stays just in the energy market. It's like throwing a rock into a pond. That second ripple started to spread, and it began creating very real fears about the health of the entire global economy. And you can literally see that fear in the numbers. On prediction markets, where people bet on future events, the odds of a U.S. recession shot up to 32%. That's the highest it had been all year. And why? Well, think about it. A sustained oil price shock basically acts like a tax on, well, everything. It makes it more expensive to ship goods, to run factories, even to drive to work. All of that slows down economic growth and seriously raises the risk of a recession. So you've got the oil shock, which is fueling fears of a recession. And now we get to the final ripple. This is where it hits investors directly, right in their portfolios. Because when investors get spooked about a recession, they sell stocks, right? They expect company profits to fall. And that is exactly what we saw happen. And this brings us right back to where we started. Japan's Nikkei was down over 1%. South Korea's Kospi, down even more, 1.7%. Hong Kong and mainland China were deep in the red too. It was a clear, synchronized drop across the entire region, all driven by that one single threat made hours earlier. But the pain didn't stop in Asia. It's a 24-hour market after all. Overnight, the U.S. markets took the baton and just kept right on running downhill. The Dow fell nearly 740 points. The S&P, the Nasdaq, all of them took a major hit. In fact, all the major indices hit their lowest closing points of the year. This is the reality of our modern, interconnected world. A threat in the Middle East can rattle a portfolio in Middle America just hours later. So, with oil prices spiking and markets tumbling all over the world, the big question is, now what? What can actually be done? Let's take a look at the immediate response and what the experts are forecasting could happen next. All right, so the first move from officials was all about managing psychology. You had the U.S. Treasury Secretary come out immediately and try to calm everyone's frayed nerves, framing the whole thing as just a temporary disruption. The goal here is pretty clear. Stop the panic from creating a self-fulfilling prophecy of economic doom. Now this is fascinating. The analysts at Goldman Sachs mapped out two possible paths. On the left, you've got their base case. This assumes things cool down, and oil eventually settles back down to around $71 by the end of the year. But look at the right, the disruption scenario. If the strait is actually closed for just 1 month, they see oil averaging $110 in the short term and staying higher all year long. This really lays out the financial stakes in black and white. And that leaves us with the critical question, the one everyone is asking. Was this just a temporary disruption, a blip on the radar, or was it the first tremor of a much larger crisis? Honestly, the answer will be decided by what happens next in the Strait of Hormuz. And you can be sure the entire world is watching.